13. From net income to operating cash flow. Why net income needs adjustment. The operating section of the cash flow statement begins with net income and works downward through a series of adjustments to arrive at the actual cash the business generated. This process exists because net income is calculated under accrual accounting, which records transactions when they occur, not when cash changes hands. The adjustments fall into two categories: non-cash items and working capital changes. Non-cash items are expenses that reduce net income but required no cash outflow during the period. The most significant is depreciation and amortization, which spreads the cost of a past asset purchase across future periods. Stock-based compensation is another major non-cash item, because it reduces reported profit through an expense entry but involves no actual cash leaving the company. Both are added back to net income in the cash flow statement because they never reduce the cash balance. Microsoft reported net income of $102 billion in fiscal year 2025. The cash flow statement then added back $34 billion of depreciation and amortization and $12 billion of stock-based compensation. These two adjustments alone added $46 billion to cash before any working capital effects were applied. After all adjustments, Microsoft arrived at operating cash flow of $136 billion, a $34 billion premium over net income. That premium signals that the company's reported earnings are conservatively stated relative to the actual cash being generated by the business. Part 2. Working capital changes and cash flow. The second category of adjustments in the operating section captures the timing gap between when revenue and expenses are recognized and when cash actually moves. When accounts receivable increase, the company recorded revenue but has not yet collected the cash, so the increase is subtracted from operating cash flow. When inventory increases, the company spent cash on goods not yet sold, so the increase is also subtracted. When accounts payable increase, the company received goods or services but has not yet paid for them, so the increase is added back. The net effect of these movements is called the change in working capital, and it can either add to or drain operating cash flow in any given year. For example, imagine a company sells $100 million more than the prior year, but all of it on 90-day credit terms. Revenue and net income both rise by $100 million, but operating cash flow does not improve until those receivables are collected. Microsoft's working capital changes reduced operating cash flow by $5.4 billion in fiscal year 2025, driven primarily by a $10.6 billion increase in accounts receivable as the company's revenue grew rapidly. This is a normal pattern for a growing business. Analysts monitor whether working capital grows faster or slower than revenue. If receivables consistently grow much faster than revenue, it can signal collection problems or aggressive revenue recognition rather than genuine growth in cash-backed sales. Part 3. EBITDA versus operating cash flow. EBITDA and operating cash flow both attempt to measure cash generation from the core business, but they differ in important ways that analysts must understand. EBITDA starts from the income statement and adds back non-cash depreciation and amortization charges to approximate operating cash earnings. Operating cash flow starts from net income and adjusts for all non-cash items, including depreciation, stock-based compensation, deferred taxes, and asset impairments, and then further adjusts for working capital changes. The gap between EBITDA and operating cash flow is explained by three factors. First, EBITDA ignores interest and taxes, both of which are real cash outflows that reduce operating cash flow. Second, EBITDA does not account for working capital changes, which can be substantial in any given year. Third, EBITDA excludes stock-based compensation and other non-cash charges beyond depreciation, which operating cash flow captures. For Microsoft in fiscal year 2025, EBITDA was approximately $163 billion, while operating cash flow was $136 billion. The $27 billion gap reflects cash taxes paid, net interest paid, and the drag from working capital growth as receivables expanded with rising revenue. EBITDA is a useful profitability proxy for comparing companies across different capital structures and tax regimes, but it overstates cash generation relative to what actually flows through the business. Operating cash flow is the more complete measure of how much cash the core business actually produced and retained during the period.